I used to check my bank app every morning, staring at the screen and feeling a tiny bit of pride about the numbers sitting in my checking account. I thought I was doing everything right. You go to work, you trade your time for a paycheck, and you save. But then I went to buy a standard grocery order, the exact same eggs, bread, and coffee I've bought for years. And the total was nearly double. That is the exact moment I realized the numbers on my screen are basically a shared hallucination. We think $1 equals $1, but the reality is, the money in my pocket is constantly leaking value. It's not magic, it's just math. Now, to be fair, inflation isn't always caused by money printing alone. Supply chain shocks, labor costs, and energy prices play a massive role. But when a government creates trillions of dollars out of thin air to fund major policies, that dilution is the part we actually feel. When millions of new dollars flood into the system, chasing the exact same amount of groceries and cars, businesses realize the market can bear higher prices. The money in my pocket didn't make me any richer. It just diluted the value of every hour I spent working for it. And don't even get me started on the opposite side of the spectrum, deflation. When you tell people about deflation, they think falling prices sound like an absolute dream. Cheaper rent, a cheaper car. Sign me up, right? But here is the blunt reality. When prices drop, the economy doesn't throw a party. It completely freezes. Think about it. If I know a car is going to be $2,000 cheaper next month, I'm not buying it today. I'll wait. And so will everyone else. But when everyone delays spending, businesses lose revenue. When businesses lose revenue, they start laying people off. Suddenly, the factory worker loses his job. And now, even though that car is $2,000 cheaper, nobody has the paycheck to actually buy it. The entire system spirals into complete paralysis. Level 2 of this game is realizing how the hidden costs of global policy are quietly passed down to us as consumers. I used to watch the news and cheer when the government slapped massive tariffs on foreign imports. A 25% tax on imported steel sounds like a great way to protect domestic manufacturing, right? But then I went to the hardware store to buy some basic metal brackets for a DIY project, and the price had spiked. Here is the trade-off nobody talks about. The foreign country doesn't pay a single cent of that tariff. The American company importing the goods pays the tax at the border. And massive corporations don't just absorb that loss. Out of the goodness of their hearts, they take that exact tax and bake it into the price tag of the products on the shelf. The politicians get to look tough on television, and I get to quietly pay for their foreign policy every time I swipe my debit card. But if you want to talk about math that feels genuinely punishing, we have to look at the housing market. 50 years ago, a single average salary could buy a home, a car, and fund a retirement. Today, I'm running data-driven fair value spreadsheets on a 50-year-old fixer-upper, and the math literally requires me to stop eating for the next 4 decades just to afford the down payment. It's easy to blame it all on a boogeyman, but the truth is a mix of terrible incentives. It started decades ago with restrictive zoning laws and neighborhood resistance. We simply didn't build enough homes, and supply dried up. But then, institutional investors threw gasoline on the fire. When Wall Street realized they could treat our neighborhoods like stock portfolios, massive funds with zero-interest cash started buying up entry-level starter homes to rent back to us. Not every investor is a hedge fund giant, but the scale advantage is very real. I'm no longer just competing against another family, I'm bidding against a corporate balance sheet. Level 3 is where people get desperate and try to force their way ahead. You see it everywhere on social media. Day trading. The promise that you can stare at a chart full of red and green candles and become a millionaire by Tuesday. But misunderstanding the difference between trading and investing will absolutely bankrupt you. Trading is betting entirely on short-term volatility. It's buying a stock at 9 a.m. and praying a news event pushes it higher by 2 p.m. And while you are sweating over a 1% dip and panic selling your savings, true investors are completely asleep. Investing isn't about timing the market perfectly. It's about buying ownership in profitable companies and letting compound interest do the heavy lifting. For 30 years, most actual millionaires honestly just look like tired dads buying light bulbs at a hardware store. They didn't hit a lottery ticket on a random meme stock. They just gave their money 3 decades to quietly duplicate itself. But what if you don't trust the institutions running the market? That is where Bitcoin stepped in. It's digital money existing entirely as code, with no central bank or CEO Instead of trusting a bank, every transaction is recorded on a public ledger called the blockchain, verified by thousands of nodes around the world. And the most important part, scarcity is hard-coded into the system. There will only ever be 21 million Bitcoin, but it has real trade-offs. The price swings wildly. And if you lose your private key, there is no customer service hotline to call. Your money is just gone forever. Still, it proves we can create currency through pure math instead of blind trust. Now, if the regular economy is driven by policy and incentives, the shadow economy is a masterclass in exploiting that exact complexity. I always wondered how billions of dollars of illegal cash quietly exist in plain sight. It's called money laundering, and it is an incredibly efficient three-step machine. Step 1 is placement. Criminals break massive sums down, buying luxury goods or funneling cash through obscure accounts to avoid triggering banking regulators. Step 2 is wiring the money through offshore shell companies until the trail is completely scrambled. By step 3, integration. They invest that scrambled cash into legitimate cash-heavy businesses like real estate developments or restaurants. They report inflated earnings, pay taxes, and suddenly, illicit funds sit cleanly in a corporate account as legal profit. But you don't have to break the law to exploit the system's mechanics. You just have to understand leverage. My entire adult life, I was told debt is an absolute trap. If I miss a credit card payment, my score tanks, my interest rate spikes, and I can't rent an apartment. But the ultra-wealthy don't run from debt. They use it as a tool. If a billionaire wants a luxury asset, selling their stock triggers millions in capital gains taxes. Instead, they use that portfolio as collateral to borrow millions at a highly negotiated, tiny interest rate. Because it's a loan, it's tax-free cash. Now, to be fair, this isn't risk-free. If the market crashes, they get margin called, and the bill absolutely comes due. But when you have that much scale, the tax advantages are incredibly asymmetric. The game isn't necessarily a malicious scam, but it is a complex system of incentives that heavily favors the people who understand the rules. If you don't know how inflation erodes your cash, how tariffs shift costs, or how assets actually build wealth, you'll always be paying the penalty for someone else's strategy. But here is the good news. Once you can finally see the invisible mechanics of the system, you can actually start playing offense. Instead of holding depreciating cash in a checking account, you can start acquiring assets with genuine pricing power, things like real estate, profitable businesses, or sound digital scarcity. The system might be designed to constantly extract wealth, but the rules of the game are completely available for anyone to learn. If you want me to break down exactly how to find assets that beat inflation or how to use smart leverage without risking bankruptcy, let me know down in the comments below. Hit subscribe, and I'll see you in the next one.